So an LLC, again, limited liability. That's the most important feature. It provides for limited liability for the members and for the managers. So the people who own the company and the people who run the company will get limited liability. You can contract that away through your operating agreement. The statute in every state, the default is limited liability for these people, but you can provide in your operating agreement that in some circumstances there may not be liability protection. If somebody acts against the interest of the company, or if somebody is engaging in fraud or criminal behavior, you can provide within the operating agreement for how far that limited liability protection goes. But generally, most people like this form because of the fact that if you do things right, you set it up properly, you maintain it properly, you will have protection from just about all liability. The reason why LLCs have become so popular and in recent years is because with very little effort, you can get pass-through tax treatment. And what that means, or actually I'll let Robert explain a little bit about what that means, but basically it gives you an opportunity to manage the profits and losses of the business a little bit.
Yeah, there are two fundamental approaches to taxing business entities. One is the approach that applies to corporate entities, and the other is a approach that applies to partnerships. In the corporate world, the corporation is a separate taxable entity. So when the corporation earns income, say $100, it pays tax at say 35%, and has only the difference to distribute to its shareholders, who are then subject to a tax on the receipt of that dividend. The flow-through approach, which has historically applied to partnerships, doesn't treat the entity as a separate taxable person for income taxes. The entity doesn't pay tax. When the entity earns $100, say, the tax is due from the partners proportionately based on their ownership interest in the entity. So you can see how this sort of flow-through tax treatment is very attractive can be very attractive for operating companies. When the LLC statute was first enacted, I think the first one might have been Wyoming.
Yeah, mid-70s.
Yeah, and maybe a little later than that. But the idea was to create a hybrid, an entity which took the limited liability aspects of corporations and married them to the flow-through aspects of partnerships. So the statute was enacted, and the first thing the IRS did was to rule that any entity formed under an LLC statute that provided limited liability would be taxed as a corporation. Ultimately, the IRS backed down on that, and LLCs now have what might be viewed as the best of both worlds. Limited liability for the players and flow-through tax treatment.
Now, that's true at the federal level always, but are the states uniform in their approach to the pass-through treatment?
Well, I haven't looked at all of the states, but I can say with some confidence that nearly all of the states follow federal tax treatment for LLCs. That, of course, has been very helpful. We'll see when we talk about S corporations later that a handful of states impose an entity-level tax on S corporations, which interfere with that sort of flow-through. But the idea of flow-through tax treatment for LLCs is, of course, very attractive, not just for operating businesses, but also for businesses which generate losses, particularly in early years, real estate and the like. Under some circumstances, those losses can be used to offset other income that the owners have, and so that, of course, can be handy. Another important characteristic of LLC flow-through treatment is that there is a wide latitude for allocating items of income, gain, or loss among the members in creative ways. Again, something that isn't possible with S corporations. And the rule is that so long as these allocations have what's known as substantial economic effect, the government will respect those allocations. And that, of course, is very attractive.
It doesn't have to be perfectly proportional, as it does, say, in an S corporation.
Well, that's right. In an S corporation, which has a modified form of flow-through treatment, the interest in the shareholders' interest in the various items is sort of a vertical slice.
Right. So if I own 10% of the S corp, I have to be given, or I have to be allocated 10% of those particular items of gain or loss.
Yeah, exactly right. So the metaphor that I use when I teach this in my class is an apple pie. If an S corporation is an apple pie, each of the shareholders has a slice of that pie that's proportionate to their ownership. So each shareholder has some crust and some apples and some sugar, and you can't deviate from that without jeopardizing your S status. With an LLC, we could allocate all of the apples to me and all of the crust to Mark, so long as those allocations have, what's known as substantial economic effect. And substantial economic effect essentially requires that the member being allocated the item for tax purposes either bear or benefit from the related economics. So if I'm allocated losses, then my capital is reduced by the amount of those losses. So going back to my apple pie metaphor, if Mark is allocated the apples and I'm allocated the sugar, then the substantial economic effect rules require me to get the diabetes.
There you go. And who doesn't like pie?
Right.
So again, the most important point is, as Robert was pointing out, there's a great deal of flexibility with the allocation rules within an LLC that make it very attractive to a number of different businesses and operations. One other point about the pass-through tax treatment, as Robert was alluding to, back in the day when the statutes first came into play, it wasn't automatic. These days it's automatic. You get the pass-through tax treatment if you form as an LLC. Back then they looked at different there was a 4 factors test to determine whether or not you could meet the standard to be treated on a pass-through basis, and if you didn't meet the standard, then you would be taxed as a corporation. But it wasn't as though the IRS told you that up front. You were sort of hoping that you had done it right and met the 4 factors test.
Well, actually, it was a cottage industry for tax lawyers, giving opinions as to whether or not these entities would be respected as partnerships for tax purposes. What Mark is referring to are the Kinter rules, and there were 4 factors designed to evaluate whether or not your entity was more corporate-like or more partnership-like. And if you had more corporate factors than non-corporate factors, the likelihood would be that you would be taxed as a corporation. And this uncertainty made planning very, very difficult, and in many cases required the deal to be sort of fit into these factors, as opposed to...
It was a lot of the tail wagging the dog, because, for example, one of the factors was indefinite life, if I recall correctly.
Right.
The corporations have an indefinite lifespan, and so you'd have to artificially create some termination date for your LLC 25 years down the road, because you could point to that if the IRS ever questioned it and say, well, we're not indefinite, we intend to dissolve this within 25 years or something like that. And now it is for people who are practicing now, it's much easier than it was back then. And there's, more importantly, from a practitioner's standpoint, there is much more certainty when you're advising a client as to what the tax treatment is going to be versus back then when it was, well, we'll draft it to meet the Kittner test, the Kittner rules, but if we don't, the IRS may come after you. So, one of the other great factors that people find with limited liability companies is how flexible you can be with capital structure and with ownership. There are no limitations on who can own a limited liability company. And as we'll see when we talk about S-Corps, it's one of the great differentiators between those and S-Corps in terms of the pass-through treatment. Most state statutes, there's a default that says that the members are the people who put in the capital for the LLC, and membership interests are whacked up according to who put in how much. But they also give you the authority to vary that within the operating agreement. And so within the operating agreement, you can have an infinite number of different classes. You can have owners from all over the world without risking your pass-through treatment. And in fact, as we'll talk about a little bit, that may be bad for your owners. Your owners may not want that. But under the applicable rules, you can do that. You can have preferred shares. You can have interests that look like debt and that pay you back at a fixed rate. There are all sorts of things that you can do with an LLC. It is essentially limitless because the state statutes, give you the authority to create in the operating agreement whatever classes of equity and whatever flavors you would like in order to meet the needs of the business that you're advising.
But there are some practical limitations. For example, we can have with an LLC almost any kind of owner, unlike an S-Corp, which we'll talk more about later. But what you'll see is that there are certain kinds of owners, certain kinds of investors that would prefer not to invest or to own an equity interest in an entity taxed as a partnership. For example, non-residents may resist owning an interest in an LLC taxed as a partnership because it would give them a filing requirement in the United States.
And who wants that?
Well, if you don't have to be on the radar, you probably are not going to want to do it. Other kinds of investors are allergic, if you will, to partnerships, and those include tax-exempt organizations. Tax-exempt organizations, many tax-exempt organizations have a lot of capital to invest, but under the rules the way they exist now, a tax-exempt organization which owns an interest in an LLC that conducts an operating business is treated as being engaged in that business. And the tax-exempt organizations don't want to be paying tax on their share of that business income. That's unrelated business taxable income, or UBTI, it's referred to. So there are circumstances under which you have practical limitations, and we'll talk more about those later.
Yep. And an LLC is actually very easy to form. As you'll see in the exhibits, there is a certificate of formation included, and it's fairly short and very basic. In Delaware, the filing fee is $500, and you can form an LLC in about 2 hours. Probably about a half an hour of work and an hour and a half waiting for Delaware to process it. Completing the operating agreement, that's a little bit of another story. Multi-member LLCs can be heavily negotiated. As we'll talk about a little bit later on, LLCs have become really the vehicle of choice for most joint ventures. So two operating businesses decide that they're going to get together and try to create a new product. How are we going to do this? In again, the olden days, we used to talk about joint ventures, which were really unincorporated associations between the two. But now, with the LLC, it's easy to create an entity that both parties own a piece of and specify what their requirements are as far as contributions and who gets what out and things like that. But completing that operating agreement can be very difficult. So when you're advising a client on whether or not they're going to use an LLC, one thing you want to think about with them is who are they going into business with, and can you work with them to get a valid operating agreement negotiated and signed in a reasonable time? And this is one of those things that, again, we'll talk about at the end, but this brings into play some of the ethical aspects of multi-client representation and the like. If someone comes to you and says, I want to go into business with that person, and I want you to draft the operating agreement, and I want you to be my lawyer, and they're going to get their own, then your instructions are very easy, and that's very clear. You know exactly who your client is, and you know whose interests you need to look out for. But that's a very different scenario than where you know one of the two people, but they come to you together and they say, we need your help to draft an operating agreement. We have this great idea for a business and we want to form as an LLC. And so now it's a little bit more murky in terms of what your role is and who you are responsible to. Is it the two of them jointly? Is it just the one person that you've known previously? You have to be, the most important point in those circumstances is to just be very clear about who it is you're representing. Set it out in the engagement letter very clearly who your client is, and especially who your client is not, and make sure that the others are aware of that, and that who your responsibilities are to and who your obligations are to. Because as we'll talk about when we get into the discussion of what's in the operating agreement, there may be provisions in there that are very helpful or very beneficial to one party while being very detrimental to another party at the same time. For example, they may have very disparate economic backgrounds. One may be very wealthy and one not. And the wealthy one is fine with not distributing any money out, reinvesting all the money in the business, things like that. And whereas the other party would like to get distributions out as quickly as possible. And so if you're not clear on who it is you're representing, you can run into some issues with advising them what's the right way to do something, what's the best way to do it, what's the most common way to do it even. How do most people look to do that? So an LLC from a formation perspective is very, very easy to get set up. It's very easy to form an LLC with the state of Delaware, the state of Massachusetts, a lot of the other states. But getting that operating agreement done can be very difficult and very time-consuming, and there are a lot of concerns that have to go into that when you're drafting and negotiating the operating agreement among multiple parties. So before we move off LLCs, I want to make sure that we address the tax questions earlier, and just to see if anybody had any questions generally on some of the more detailed attributes of the LLCs.
Well, while we wait for questions, why don't I talk about a couple of tax issues that go into the decision to form an LLC. The point that Mark raised earlier about the disparate interests of the parties on distributions is an important one, and let's talk a little bit about why. The LLC, as we said, is a flow-through entity that's not subject to tax itself. Again, the items of income and gain flow through and are reported by the members on their own tax returns. Now, this is true whether or not any of that income was actually distributed. So if Mark and I are partners in a partnership that generates $100 of earnings of income in year one, both he and I, assuming we're equal partners, are responsible to pay tax on 50 of each of the income. Now that's true even if not $1 of that 100 was distributed. Well, so when we form our LLC and discuss distributions as part of our own operating agreement discussion, we want to be sure if one of us or both of us need that cash to be distributed to pay the tax, that there's a requirement that that's going to be done. Other issues on formation include the transfers of the initial funding of the company. This is done by transfer sometimes of cash. Sometimes it's done by a transfer of property. Sometimes it's done through the performance of services. The formation of an LLC is typically tax deferred with respect to the contribution of cash and the contribution of property. LLC interests issued for services are typically taxable. Another trap for the unwary, if you will, is the contribution of property which is encumbered. Subchapter K has an interesting nuance which treats the debt associated with contributed property as being assumed by the entity and in part by the other partners. So if I contribute a piece of property that's worth 100 with debt associated with it of 25, the partnership is treated as having assumed that debt, and half of it will be, in my case, assigned to Mark and half to me. If my basis in that contributed property is low, then the assumption of that debt can trigger gain to me. So anytime property which is encumbered is contributed to a partnership, if that property is subject to debt, you want to take a real close look at that, because the debt relief which will follow from the contribution could trigger an unexpected tax.
Yeah. And again, that goes to, one of the things we're going to talk about in the ethics portion is this idea of the obligation to have the skill and the knowledge and experience in terms of representing your client effectively with what they're looking to do. That's one of those points that gets lost on a lot of people. Frankly, it's not something I'd ever been aware of until fairly recently when Robert pointed it out with a client that we were working with. And so it is critical when you're dealing with some of these issues to be very sure that you know exactly what you're doing with respect to the tax treatment of the LLC property, the provisions themselves of the LLC operating agreement that deal with both tax and other distributions, and just generally the formation and the negotiation of the operating agreement. I think we have a question that came in.
Yeah, we have an interesting question about LLCs and personal liability. The question is, what is the level of protection that an LLC gives an individual who's operating as a single member LLC? If there is a claim brought, what is subject to that claim? Now, of course, in any limited liability company, whether it's an LLC or a corporation, you can't protect yourself from your own bad act.
Right.
So if you form a single member LLC to operate a delivery service, and you're driving the car or the truck and you bump somebody, then of course there's a claim against you personally for your bad act, and they can go against your personal assets, and one of your personal assets is your interest in the LLC even, and that's subject to a claim. If we're talking about a different kind of liability, say a warranty or a guarantee or something, maybe a slip and fall in the premises, then ordinarily
a claim for a defective product that the LLC the single member LLC is a manufacturer. They built a widget. The widget blew up and injured somebody.
Right.
So what's the personal liability with respect to the claim for the person who was injured?
Right. Well, ordinarily, if the LLC is respected as a separate legal entity, and you could talk about what's required there, then the owner of the entity is protected.
Right.
Now, the question asker says, well, what about funds that came in that were paid out to the owner for either distributions of profits or compensation for services? Under what circumstances can a claimant, a plaintiff, bring an action against the owner of a single-member LLC to recover value which has been distributed?
Mm-hmm.
Now, both states have some variation of the Uniform Fraudulent Conveyances
Right.
Act, so that if there has been a distribution with the intent to evade or defeat the payment of a creditor,
Mm-hmm.
then the recipient, the transferee of those assets or property are fair target. And,
Right.
and you have to expect you're going to be sued. A good plaintiff's lawyer is going to sue everybody.
Right, but the states also, in addition to the Uniform Fraudulent Conveyance Act type statutes, they also typically, within both the corporate and the LLC statutes, impose liability on those decision makers if they're authorizing distributions out that they know are subject to claims, or if they're authorizing distributions out that they know are going to render the company insolvent.
That's right.
That they would then have personal liability for those decisions to distribute that money. So I guess to sort of summarize it to some degree, if you're a single member, if you own a single member LLC and you've received some money in and you're authorizing it out to be distributed out to you when you know there are potential claims, that probably, the LLC is probably not going to give you much in the way of a shield, because it's you making the decision to distribute that money out. Now contrast that with an LLC that has 50 members and each of the members receives a distribution, but they have nothing to do with the decision to distribute that money out. That's done by the managers, and they distributed the money out. Those individual members who are passive and who receive that distribution, they are not going to be subject to liability, because they're simply getting their distribution as a result of their ownership of the LLC. They're not making the decision to distribute out the money or anything like that. So, as Robert said, you can't protect yourself from your own bad acts. It won't help to shield you if you're the one who has done, something bad, a personal injury or a fraud claim or something like that. And number two, if the single member owner is authorizing distributions that they know or are likely to render the company insolvent or unable to pay a judgment that's coming, that they know is coming, then you're probably going to have some problems there as well. Where they don't know about it, if it's something that's unforeseen, that's a little bit more of a murky area, and you have to look to the state law in the various states to get a sense of how that would be handled. Like, for example, you don't know about a claim. The widget blew up, but you don't know about it. It happened a year ago, nobody's made a claim, and in the interim you distribute some money out. That's a slightly different issue, and you have to look in those circumstances at the state law to see what the case law says in those circumstances. And I just want to go back very briefly to something that Robert pointed out. He used the phrase respecting the formalities. And that's something, unfortunately, we see quite a bit in our practice. People come to us, they've set up an LLC, they're doing business as the LLC, but they're paying some checks for the business, they're paying some bills out of their personal account. They're not keeping good records of when they invest money into the corporation, so it's not clear what came from the company versus what came from the personal funds. They're having people who owe the LLC money pay them directly instead of having it go through the LLC account. They let it lapse. It's not in good standing. They let it lapse with the Secretary of State because they haven't been doing their filings. Those are the things that are not respecting the corporate formalities, and the more of those that you have, in other words, the less respectful you are of the separation between the LLC on one hand and your personal business, your personal finances on the other, the more likely it is that a court is going to decide not to respect the LLC form and the protection that it provides. So it is very important that you keep it. It's just like a corporation. You have to make annual filings. You have to segregate the checkbooks. You have to document when you're putting money in, document whether it's a loan or it's an equity investment, so that, to the outside world, if someone came to take a look at it, they would know what was going on.
Now, this is true of all entities, of all
Correct.
limited liability entities. This is true of LLCs. This is true of C corporations. This is true of S corporations that have made a C corporation that have made S elections, and limited partnerships.
Yeah, that's exactly right. That's a very good point. It's for any entity that offers that sort of protection. If you don't respect the corporate formalities and you get sued, it's likely that a court will look through or won't honor the protection that the entity provides.
Yeah.
So
now, another, while we're talking about special circumstances, there's one more special circumstance that can cause an owner or a manager of a limited liability entity, like an LLC or a C Corp or an S Corp, to be responsible for debt. And that's with respect to trust fund taxes. Trust fund taxes are taxes imposed by the federal government in many states on entities as collectors. Employment taxes is an example of that.
So it's not just wealthy people who have a trust fund that have to be worried about this?
That's exactly right. Although I'd like to worry about that myself. Sales taxes is another example where the tax is being collected by the entity in trust for the government. Those taxes, if not properly deposited, can trigger liability not just for the entity but for the decision maker who didn't pay those over. If you have a client that comes to you and says, I've got employment taxes and I haven't made deposits, that's something you need to deal with right away, because that will result in liability for the individual owner, for the individual manager, whoever who is deemed to be a responsible person.